It was the late 1990s, and Enron was the darling of Wall Street. The energy trading giant promised investors endless growth and rock-solid profits. To keep that image alive, Enron's executives cooked up a clever scheme involving dozens of special-purpose entities, essentially shell companies that existed only on paper. One day, Enron's CFO called a meeting with the finance team. "We need to move some of our debt off the books," he said. "Let's create an SPV, sell it a power plant at a sky-high price, and have the SPV borrow the money to pay us." The team drafted the paperwork, and the SPV, named Cactus, was born. Cactus bought the plant from Enron for $500 million, even though the market value was closer to $300 million. Enron booked the $200 million difference as instant profit. To fund the purchase, Cactus took out a $500 million loan from a syndicate of banks, using the plant as collateral. Because Cactus was a separate legal entity, the loan never appeared on Enron's balance sheet. Behind the scenes, Enron signed comfort letters, promising to cover Cactus's debt if anything went wrong. Those letters were buried in the footnotes of Enron's annual report, and most investors never noticed. For a while, the trick worked. Enron's earnings looked spectacular. Its stock surged past $90 a share, and executives cashed in huge bonuses. But the house of cards was fragile. Energy prices fell, the plant's cash flow dried up, and Cactus could no longer service its loan. Banks started demanding repayment, and Enron had to dip into its own cash to honor the hidden guarantees. When a journalist's investigation exposed the massive off-balance sheet liabilities, panic set in. Enron's share price collapsed to pennies, wiping out billions in shareholder value. Thousands of employees lost their jobs and their retirement savings, which had been heavily invested in Enron stock. The scandal prompted regulators to pass the Sarbanes-Oxley Act, forcing companies to be far more transparent. In the end, Enron's dazzling facade crumbled, leaving a cautionary tale about the dangers of opaque financial engineering and the importance of digging beyond the headline numbers.